Hi and welcome to Swissquote's Daily Market Talk. It's Monday, June 9th. The week kicks off on hope that the second round of trade negotiations between the US and China could lead to further progress. US crude consolidates near a critical technical level this morning, and the US dollar is weaker, but after a rebound on Friday on the back of surprise strength in the US jobs data, while futures are slightly in the red this morning. So this week, we will be watching the trade negotiations, of course, but also the US inflation data and Oracle and Adobe earnings. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own, and this is not financial advice. So last week ended on a positive note. Improved headlines on the trade front between the US and China and a set of better than expected jobs data from the US on Friday sent the S&P 500 up by 1.5% during the course of the week. Then Nasdaq 100 rallied 2% last week despite a severe sell-off in Tesla shares amid a heated dispute between Trump and Elon Musk on social media. As such, Nasdaq 100 closed the week a few points below the all-time high level reached in February, as the S&P 500 hit and closed the week near the 6,000 psychological level, and it is the first time since February that we have seen the major US index trading near this level. We are, on the other hand, approaching overbought conditions, so be careful. Note that Friday's rally was mostly driven by the narrative that the US economy remains surprisingly resilient to the trade chaos and trade uncertainty, because the US economy added 139,000 new non-farm jobs last month. That was better than expected, while the wages grew unexpectedly faster than expected as well, given no doubt to the Fed hawks that the Federal Reserve won't be cutting the interest rates in July. So September looks to be the earliest stage to expect the next rate cut from the Federal Reserve. And again, it all depends on inflation. So Wednesday this week, the US will be publishing its latest CPI updates, and the latest numbers are expected to point at growing price pressures, both on headline and core inflation metrics, a thing that could eventually further cool down the expectations that the Federal Reserve will be cutting the interest rate sooner rather than later. So the US 2-year yield jumped past the 4% mark on Friday, and the Fed will certainly not be a driving force for equity bulls at the current levels. However, a good or maybe a stronger than expected sale of US 30-year bonds that are due on Thursday this week could help soothing nerves on the long end of the US yield curve, which has been under the pressure of US budget shenanigans, as the 30-year yield opens the week just below that 5% psychological mark this Monday. Now, optimistic trade news from the US-China front could help to mind you. Speaking of inflation and trade, Chinese exports grew much slower than expected in May, which is normal amid triple-digit import taxes that remain very high even after being brought lower, while imports in China tanked significantly more than expected by analysts. Then consumer prices in China fell for the fourth straight month as the decline in producer prices accelerated. Now, Chinese equities kick off the week on a slightly positive note, on thinking that the weak economic data from China will allow the People's Bank of China and the Chinese government to continue giving ample support to the Chinese economy, along with hope that the second round of talks between the US and Chinese officials on the trade front could maybe, but just maybe, lead to some more progress. Now, last week, remember, the phone call between Donald Trump and the Chinese President Xi Jinping resulted in news that China would relax the export of rare earth metals toward the United States, hinting that the US could also maybe show some compromise of its own, and it could relax the technology exports toward China. But some people out there will keep warning that the second round of trade negotiations between the US and China may not bring substantial progress as the first round did. So any lack of progress on this front could eventually encourage the equity bulls to take profits at the current levels and maybe return toward the sidelines. In the earnings front, well, two technology companies in the US, Oracle and Adobe, so they will be announcing their earnings this Wednesday and Thursday, respectively. Oracle earnings will be an update for the infrastructure side of the AI play, while Adobe will actually serve as an update on whether consumers, the end consumers, are willing to pay for the AI tools. Now, note that Oracle's infrastructure business printed a 50% growth last quarter on demand from big names that we know, including Nvidia and OpenAI. But the multi-billion-dollar Stargate data expansion plans will actually brings investors' attention toward cash flow and the company's profit margins. Whether the company is spending too much on AI, then investors could stomach. So Oracle investors are hoping that juicy earnings this week could back a further rally toward the $200 per share mark, while Adobe investors need to know that potential users are actually willing to pay for its tools beyond finding them cool and playing with them to keep the share price above the 100-day moving average level. For now, the AI rally is still carried by the AI enablers, which are the big technology companies, big spenders and builders, and the part of the end consumer demand and revenue lag behind expectations, mind you, but that is exactly where the real potential will be when the AI rally matures. So companies that are offering AI tools to end users will probably be the future of AI, and companies active in these areas are quite cheap today. Elsewhere, while the European growth numbers on Friday came in stronger than expected by analysts, while Irish and German growth figures particularly attracted investors' attentions because they were better than expected. The surprise was mostly due to net trade, mind you, as the European exports accelerated ahead of the US tariffs, and that could be quite temporary, but investment also rose in the first quarter of this year, and that's in line with the rhetoric, with the narrative of more government spending in the continent's security. So the SOX 600 index closed last week 0.90% higher. The euro dollar remained bid below the 114 mark, even though the pair has been unable to break the 115 psychological resistance after the European Central Bank delivered an additional 25 basis point cut last week while announcing the end of the rate cutting cycle. But still, inflows into the euro-denominated assets should continue to keep the euro upbeat against the US dollar. In Japan, the latest GDP figures released early this Monday hinted at stronger than expected growth figures in Japan, with more heated than expected inflationary pressures fueling the hawkish Bank of Japan expectations early this week. The dollar yen is testing the 50-day moving average to the downside at the time I'm talking here this morning. Returning below this level should encourage a further decline in the USD JPY. A major support here is seen near the 142.50 142.75 range. In the energy front, US crude rallied more than 5% last week on the back of trade optimism, a weekly decline in US oil inventories, and strong NFP read on Friday. Now, the barrel of crude is consolidating gains just below the $65 per barrel mark this morning. Any positive news on the trade front this week could eventually send the price of a barrel above the $65.35 per barrel mark, which is the major 38.2% Fibonacci retracement on the year-to-date decline, and should distinguish between the year-to-date bearish trend and a medium-term bullish reversal. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.